Hello, Namaskar viewers. I am Sanjeev Pandya welcoming you to this week's edition of the Business Talk with Ajay right here on ITV Gold. This weekly show brings you in-depth knowledge of businesses that we bring you, all the information that you need to know. Now, the businesses which are South Asians are most engaged into it. And that's what we give out, all the information, what kind of business is that, what does it take to start up that business, what does it take to maintain and operate that business, what are the challenges, what are the pros, what are the cons, and how can that business fail if you're not very careful. In that discussion, we always bring in a tax angle. The reason to bring in a tax angle is because the show is brought to you by CPA Services, a full-fledged professional accounting firm located in the state of New Jersey. They are in New Jersey, but they can help you no matter where you are. Any tax matter problem, personal or corporate, or if you need a virtual CEO, CFO, bookkeeping services, payroll services, and if you have a letter coming in from IRS regarding tax audit. The reason I said tax audit, I tell you why. So if you have that letter about tax audit, they can also help you out to guide you and to come out of that audit. Remember, CPA Service believes in doing taxes right. You got to do your taxes right. You're entitled to all the deductions, but at the end of the day, you must do it right. That is what CPA Services believes in. And we believe in having one of the most prominent individuals of CPA Services in the show. That's Mr. Ajay Kumar, CPA and MBA, with over 30 years of experience, CPA Services. He joins us every week. Once again, welcome to the show, sir.
Thank you, Sanjeev. Thank you for the kind introduction.
You're very welcome. I deliberately paused when I mentioned two words, tax audit.
Absolutely.
These are the most important words, tax audits, because today's topic is tax audit. We're going to find out what exactly tax audit, how it is worked, and how IRS picks up the returns for the tax audit, and what are the things that they use. I mean, you perhaps will not find this much detailed information anywhere, and we're going to find out from Mr. Ajay Kumar. So, Ajay, tax audit. Let me ask you a question. How many tax audit cases that you get in a year? And not from your client, because I assume that your clients are definitely safe, but somebody comes in at the last minute, say, help me out.
Well, you're right. We get hundreds of such cases, and you're right. We pick up more clients because they are getting audited as opposed to new tax clients. And when we help a client in resolving their tax audit issues, then they become our clients for life.
Correct.
So as a practice, we pick up more new clients because they were audited, they did not do something right, they did not follow the instruction, or a lot of people who did their own taxes. Those are the people who get audited because they don't really know the basic rules. So in this episode, we'll try to cover why IRS audit, how do they decide who to audit, what are the criterias, and most importantly, what can you do to avoid such an IRS audit?
Very good. All right. So what can you do to avoid an IRS audit? But before that, let's just give our viewers in-depth information on the varieties of audits, or rather types of audits.
Absolutely. So in this episode, we'll be talking more on the IRS income tax audit. So any tax return that you file has two components to it. There is a federal component, there is a state component. In many cases, many people file taxes in more than one state. So they are exposed to multiple states. There are a lot of people in our area lives in New Jersey, work in New York. So at the end of the year, they file taxes in New York, New Jersey, and with the federal government. So you have an income tax audit potential with New York, New Jersey, and federal government. If you have a small business, then you can have Department of Labor audit type of situation. Department of Labor audit rules are typically governed by the state. So most Department of Labor audits are the state. Not that the federal government cannot do it, but it's comparatively very rare. Department of Labor audits are typically done by the state. Then you have workers' comp audit, or you can have, in a worst case scenario, an immigration audit. Immigration audit are typically for the IT consulting companies, or cash intensive business, where we know the labor is not properly documented. Let's say if you go to a proper ethnic restaurant, you have 30 people working over there, and on the payroll you have 5, 6, 7 people being shown over there. And a lot of those people are not properly documented. They do not have the proper social security number, proper work authorization. So in that case, that could be a potential immigration audit. So you're 100% right, Sanjeevji. There are so many different type of audits. And depending on the type of audit, depending on the government that's auditing, depending on why they are auditing, your response has to be customized per that audit. This episode will be talking about income tax audit, not Department of Labor audit, not workers' comp audit, not immigration audit. We are focusing on income tax audit, even though we'll be talking about the IRS in general, but a lot of this information can be used for the state audit as well. What you have to avoid, what you want to be avoiding so you don't get audited by IRS are the same principle that you want to be avoiding to avoid the audit for the state government as well.
All right. Okay. Having said that, let's go into a little bit of more detail. The tax returns are prepared, there are individual tax returns, there are, corporation tax return, there are partnership tax returns, and then there are other varieties of returns also. Let's go step by step.
Sure.
The personal income tax return, the ratio of that personal tax return are audited.
Well, it depends. More income you make, higher the audit probability you have. But in general, if you look at the total set of database, about 0.5% people get audited. What it means is out of 200 people, 1% get audited. Again, more income you make, if you have more than $250,000, your income probability is much higher. If you have more than $1 million in income, then your audit probability is way higher than a general person.
Okay.
And the theory is, if you are making only $30,000, by auditing you, we know that you are lying on the return. But by auditing you, how much money can the government collect? But if you are making $3 million, by auditing you, government can collect thousands of dollars.
All right, so that's individual tax returns, and of course individual tax returns, over $1 million, over $200,000, whatnot. Now let's look in the corporation side.
Yep.
There's a S corporation, C corporation, and the LLCs. Let's see if we can give them some ratios on those.
Absolutely. So we will show on the screen here for the individual tax return, we have 0.5%, as we talked about. If your income is over $1 million, your audit probability goes 6 times higher. So your audit probability is 3%, 3.2%, 3.3%. If you have a partnership, your audit probability is about 0.5%. S corporation is even lesser. And C corporation, you have to remember, are typically the large corporations in UG.
Yep.
So they are making a lot of money. I mean, a lot of people, unless you have the foreign ownership, or unless you are a public company, or unless you have a specific need for a C corporation, you will have either an LLC or an S corporation. So C corporation's audit rate is typically very high, as much as 8%.
8%.
Yep.
That is very high. But again, like you say, it's for the large corporation. All right, quickly look into it. IRS hiring spree. I hear in the news most of the time. I read it also that IRS is hiring more and more agents to go after the tax audit matter.
Absolutely. Under the TCJA Act, a few years ago, IRS was allocated $80 billion to hire 87,000 employees over the next 10 years. Right now, just in last year alone, IRS hired 5,000 employees. IRS has a mandate to increase the number of audits by 50% over the next 10 years. So a lot of people are going to get audited. A lot more people are going to get audited. If you take a step back, it's a profit center for the government. Government spends money, invests money into these auditors, and these auditors earn money back for the government. So IRS is on hiring spree, meaning they are hiring a lot of employees, a lot of people. Over the next 10 years, they are expected to hire 87,000 employees to increase the audit rates by 50%.
All right, good. Now let's go into the, how to avoid tax audit. We have 2 minutes left, and I think there are 2 important points we can cover. How to avoid tax audit. We all know, you've been saying it, that how to avoid tax audit, right? But what they should be careful about, starting with, all your expenses. Make sure that all your expenses are okay. Don't go over the board on a tax return thinking no one's going to notice that, and then I can take credit and so on and so forth. That's one thing, correct?
Absolutely. 100%.
Elaborate a little bit more.
So all the receipts has to be contemporaneous. If you have legitimate receipt, let's say if you truly spend $5,000 on certain expenses, and even though it's high, as long as you have the right receipt around it, as long as you explain in your tax return how it happened, why it happened, instead of putting $5,000 into travel expense, if you can break it down based on your situation into smaller pieces, multiple pieces, to justify right up front, your audit probability will be lesser. The other thing you can be concerned about, you can be careful about, don't put $5,000 together. If you have $4,996, put $4,996, don't round it up. If you put $5,000 in travel expense, the audit probability is much higher. If you break it down, airfare expenses, client travel expenses, reimbursement to the employee's expenses, if you break it down into real unrounded numbers, $1,237, $111, then the audit probability is much lesser as opposed to jumbling it up or estimating to a rounded number.
All right, there is the other thing also, how to avoid tax audit, and that's the itemization. Everyone's favorite is itemization. But before we talk about itemization, we must take a break. We'll be right back after this messages.
Absolutely.
Welcome back to the second half of the Business Talk with AJ. Right here on ITV Gold. This is the show, brings you all the things that you need to know about businesses, different businesses, categories. That's what we discuss in this season 3 of the Business Talk with AJ. But today we're talking about tax audits, because tax season is just around the corner, but September month is also an important month, because on September 15, tax returns are due for many corporations. So AJ decided to give you all the information that you need to know about tax audits, how do they work and whatnot. Once again, the show is brought to you by, of course, tax accounting firm. That's a Science CPA services, everyone's favorite, and everyone really likes to have their tax returns done over there because they believe in doing taxes right, doing taxes appropriately. And if you are in a tax audit, they can also assist you and guide you in the right direction. With multiple locations in the state of New Jersey, but they can assist you no matter where you are in the USA. They can be reached at 908-380-6876 or visit their website sciencecpaservices.com. All right, AJ, before the break, as we were talking about where they should be careful, where the taxpayer should be careful to avoid the taxes, one thing we discussed is the expenses, and you said that whatever the expenses are, make sure you have the receipt and everything else. Another area is everyone's favorite, because everyone likes to take a little advantage, which is itemized deductions. And there are several things in itemized deductions.
Absolutely. So itemized deduction typically includes the medical expenses, property tax, mortgage, donation. So there are 4 main categories over there. The gray area over there is either the medical expense or the donation, because mortgage interest is a black and white number, property tax is limited to $10,000. So leave those 2 aside. Medical expenses are not deductible unless they are more than 7.5% of your AGI. So medical expense is a non-issue. The bigger issue over there is the donation. In donation, the rule is if you are donating more than $250 to anybody, you better have contemporaneous receipt around it. You have to have a receipt at that time of donation. You cannot really say, I put the money into the hundi in the box at the temple. You cannot say, if the need be, I can get the receipt. You better have the receipt while you're filing the taxes at the time of donation. You cannot really say, I can get the receipt. So donation is the main area over there when you have this itemized deduction. So be careful if you have been donating 1% of your income for last 10 years and suddenly you have $100,000 of donation, which is much larger compared to your total income, then you better explain it on the tax return that this year my donations are much higher because of this thing, and here is a receipt. There is a way for you to attach the receipt with the tax return. Especially if you are doing it yourself, make sure you have the proper explanation right up front, especially if the numbers are not in line with your prior history. A lot of people ask us, Sanjeevji, how much is the regular donation? How much can I donate? Is it 2% okay? Is it 1% okay? So it's not about how much is okay in general. There are people who donate 10% of their AGI consistently. There are people who don't donate even 1%. So you look at your own history for last few years. How much have you been donating in terms of percentage? And then if this year's donation is far more than your historical percentage donation, then you better explain it right up front on the tax return.
All right, so that's itemized deductions. Now, with itemized deductions, there is also something goes very similar to it, which is provide appropriate detail.
Absolutely. So for anything, so we talked about the expenses in general, we talked about the itemized details, we talked about donation, anything that's out of proportion for you. You started a new business that's this year only, and you have $50,000 of expense. You better have a form along with the tax return explaining what the expenses are, why this year's tax return is different than compared to what you used to file. So if you can provide the explanation right up front, you make their job, IRS job, easier, and you have lesser probability for being audited.
Okay, very interesting. Does filing taxes on time help to avoid the audit?
Well, it does and it does not. So the audit is one part of it, but if you filed your taxes late, then you end up paying interest and penalties around it. But if interest and penalty is not the subject, if you file the tax return by, let's say, March 15th for business or April 15th for personal, millions of tax returns are being filed at that time. The audit probability is much lower because a lot of people are filing it. IRS wouldn't accept it, but if you look at it statistically, more taxes that are audited are the ones where the extension was filed as opposed to where the extension was not filed. Percentage wise, IRS will take a stand back and say most tax returns that are filing the extensions are more complicated tax returns, more cumbersome tax return for an exposure tax return. That's why the audit rate is high. But the truth is, the tax returns that are being audited are more come from the subset where the extension was filed as opposed to where the extension was not filed.
Very true. Now, when it comes to tax audit, help me out. When it comes to tax audit, what is that one should be careful? To file amended tax return or to file an extension for the tax return to be filed later?
Two different concepts here.
I know that, but which one can trigger more audit?
Well, extension cannot trigger the audit.
Okay.
You file the extension and you file the taxes
on time,
within the
before the due date.
Before the due date.
Correct.
The fact remains, though, as we discussed earlier, more audits are done for the taxes that are extended as opposed to the taxes that are not extended. But that's besides the point here. Take a step back and ask yourself, why would somebody amend the taxes? People amend the taxes because they know they can get some money back from the government. They forgot to do something. They forgot to claim something. That's why they are trying to amend the taxes. So by definition, amended taxes are the taxes where government is expected to pay you back. If an amended tax return were all paper filed. Now in these days they can be electronically filed for last 3 years. So the rule is all amended tax returns have to be thoroughly checked before an additional refund or any refund can be issued against the amended taxes. Just because amended tax return by definition 90% of those taxes are only to get money back from the government, the scrutiny is much higher.
All right, in some cases it could be the correction to the tax return that was filed, something got missed or something.
Right, but most people will amend it. You're right, they missed something, but missed something that was supposed to go in their favor.
Correct, yeah.
If they missed something where they would have owed additional $5 to IRS, they probably are not amending it.
Yes, exactly.
So by definition, amendments are done because the taxpayer can expect some money back.
Okay.
So knowing that the amendment by definitions are going to request some money from the IRS, the scrutiny is much higher.
Okay.
That's why the amended tax returns are more prone to audits than the regular income tax return.
Okay. Now, what's up with rounding numbers? You always tell people don't round numbers too much. What's wrong with it? It's easy to round numbers.
Yeah, right, absolutely. But it shows the IRS they are not the real number. It shows you are estimating the numbers. We had a new client who came to us for audit, and they were making only $20,000. We knew the IRS auditor. We did work with the same auditor earlier. So we called the IRS auditor. Why are you calling this person? She's only making $20,000. What's wrong with you guys? Don't you have anything better to do? And this guy said, Mr. Kumar, please take a look at the tax return and then you will understand. He emailed the tax return to us. He sent the tax return to us. We looked at the tax return and every single thing was rounded. Income 20,000, uniform 1,000, travel 2,000, utility 3,000, phone bill another 1,000. It is just not possible. You cannot have every single number. We know she's making up these numbers. We spent some time, it took us a couple of months, we got $14 back from the government. We got her some money back, but the stress, the associated headache around it is not worth it. So you want to be as exact as practically possible. Do not try to round up the numbers.
That's a good. Sometimes rounding too much is not too good.
Absolutely.
So be very careful.
I mean, we are not asking you to put the decimal. $286.70 is not needed. 287 is okay, but rounding 287 to 300 is not okay.
Very good. Good point. That's a very good point. All right. There's also saying that don't make excessive deductions. Meaning you have, when you file tax return, you have all these categories in front of you, right? And you are so prompted to say, oh, I got this line.
Yep, you're right. Especially on Schedule C, especially when you have a home-based business.
Correct.
People go out of their way trying to claim the mortgage, trying to claim the food, trying to claim the furniture, trying to claim the rent. It gets too much, and you take a step back. Your income is $1,000, your expenses are adding up to $27,000. How is it making sense? Why are you even doing this business if you are losing money every year? $26,000 in this example. So the rule here is any expense that you wouldn't have had if you did not have this business is a business expense. So you would have been living in the same house anyway. So how is the mortgage an expense? You would have been having the same phone, same internet. Even if you have to do it, take the square footage. I mean, the whole house is 3,000 square foot. My office is 10 by 10, 100 square feet. So maybe 3% of the total expense makes sense. If you're trying to push mortgage, half of the mortgage, or paying the mortgage through the business account, making the car payment through the business account and have no income, that's excessive. That will push you towards an audit.
All right, now we are really pushing it because we have 1 minute left and we got quickly 2 or 3 topics covered, and then short as much as possible. You mentioned Schedule C, right? Taxpayers should use Schedule C to report profit and losses, correct?
Well, if you have a side business, if you are getting money through Zelle or Venmo or through any wire transfer in your personal account or in your business account, you better report it. Tomorrow if you get audited, IRS will ask your last 2 years personal bank statement, and if they see deposits other than your job, other than your regular income, they will say where this money coming from, and that's where the Schedule C comes in.
Okay, all right. So then, and the last 2 things, one of them is very important, but the second most important is that do not leave questions blank.
Absolutely.
Whatever it is, answer that, yes or no.
Absolutely, 100%.
All right, and the last thing is, remember to sign your tax return. Do not mail out or do not file unsigned tax return, because that could trigger the audit.
You're right. As much as it sounds silly, why would somebody be sending unsigned tax return? But a lot of people misses it. Only 55% tax returns are e-filed. There are a lot of tax returns that are still paper filed. If you have a paper file return, make sure you sign it. Make sure both your spouse sign it. If it's a married filing joint tax return, date it properly, send it via certified mail so you have a proof that you mailed the tax return.
All right, thank you so very much. In the end, I just want to say one thing very clearly is that, we are just getting into now September. Depends upon when you watch the show. Either we are in September or we are in the last day of August. So anyway, September is around the corner. September 15th is the tax deadline. Also, one note that you should make is that between now and December, between September and December, you should take advantage of investing money. Wherever you have extra money, just invest it somewhere so you can reduce your tax liability. There are several programs that you can invest it to reduce your tax liability. It's not to get more refund. Remember one thing, it's a reduce your tax liability. And Science CPA Services is one of the most well-known firms that they can guide you and advise you where you can invest the money to have your tax liability reduced, and at the same time enjoy the return on that money that you are investing somewhere else. Am I right, Ajay?
Absolutely. We are in the tax planning session.
Exactly.
These months are called tax planning months. A few minutes spent on the tax planning can save you several dollars.
All right. And watching our show can also save you a lot of hassles, because every week we bring you the information that you really need to know. With that note, I'd like to thank Mr. Ajay for his time and a valuable input in the show. And remember, Science CPA Services, 908-380-6876 or sciencecpaservices.com. I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.
Thank you.